Hey there, thanks for tuning in. Welcome to Investing in Germany. And now it's time for the weekly market update. That was a really strange unofficial news coming into the market where Alibaba is trying to shift its headquarters from mainland China to Singapore. Whether it's a good news or not is something that I don't know, but then the market was not really happy with it. And the stock tanked by 6% as soon as this news came into the market. The second or the most important thing that happened during this week was the annual general meeting of the Daily Journal, where Charlie Munger, at the age of 99, was present there and answering questions for 2 hours and 30 minutes. That was a really great discussion to see, and also a lot of insights there on how to start investing and so on. So the three main takeaways from me from this meeting was that first, he admitted that investing in Alibaba was one of the worst mistake that he could have done. The reason why he said it was one of the worst investment decisions that he had made is because he saw Alibaba as a technology company and not as a retail company. So there is quite a difference between the technology company and a retail company, because the technology company means it's a high margin, high growth business, but the retail industry, it's a lot of high volume, low margin business. So there's not growth, but there's a lot of volume happening in the retail industry. But in technology industry, it's a lot of high margin business there and really high growth over there. Is something that he failed to see from the Alibaba, from the surface level. And he really came to know about this only after the detailed analysis, after the investment. This is quite an interesting view on how you see at the Alibaba. Myself, I already exited Alibaba some weeks back because of the issues that we see from between the China and the America. But then he also really pointed out that whatever we see from the Chinese and the Americans is not going to materialize into the worst scenario. But then we don't know anything could happen. But he is a sharpest mind. And I'm sure that he sees it in a much more wider angle than I do. But I don't want to take a risk on my investments anyways. And the second most interesting topic that he mentioned during this discussion was about the semiconductor industry. As you know, semiconductor industry at the moment is a really hot cake. It's like one of the hottest thing that you can invest in. We have AMD, Intel, and we have a lot of fight between the American and the China, where America is really pushing hard on Chinese on the technology. And then they are starving Chinese of the new technologically advanced equipments and so on. So it's a really hot cake to be in at the moment in the semiconductor industry. But Charlie Munger pointed out a different view on investing in semiconductor industry, because if you see, semiconductor industry is a really high capex intensive industry. Even though they create a lot of cash flow from their operations, they can't do much with those cash flows. They have to again put all the money that they created with the new technology again into the another technology, which will come into play in the next couple of years. So they are, even though they create a ton of money from free cash flow, they have to save it and then again invest back into the next technology, and this cycle never stops. And therefore semiconductor industry companies within the semiconductor industries, they don't have the opportunity to save that money and invest in something different. So this is one of the main reasons why Charlie Munger also hates to invest in semiconductor industry. Myself, I invested in semiconductor industry in the past, like Intel and so on, even though I exited on a positive note. But I was really tracking them to invest in the next cycle. But then this view from Charlie Munger, where they can't do anything with the money, is something for me to have a look and think about it. Of course, you can see here the investment mindset is completely different, and it takes a lot of time and a lot of energy for us to really understand before we make an investments here. So it's a really good view what he presented there, and something for me to digest in. And the third important topic that he said was something not new, where he just said the idiotic investment opportunity that we see in the Bitcoin, which is worth nothing and just speculation, and it should be banned outright, but like the Chinese. He was really blunt on that and said that the Americans, politicians, policymakers are doing the worst job there by not banning the cryptocurrency and crypto assets like the Chinese do, and so on. So it's not something new that we hear on this topic. But then, I'm not now invested into any Bitcoins or anything else. So it fits into me, and happy to see such a statement coming in from Charlie Munger there. So moving away from Charlie Munger, so we had a consumer price index coming in for the America, and it was slightly higher than the consensus, which makes a lot of opportunity for the central bankers, the Mr. Jerome Powell, to increase the interest rate even higher. At the moment, market is predicting that the interest rate would peak at around 6%. If you rewind back like 6 months back, the market was expecting 4.75 to 5%, and now we are ended at 6% thanks to the strong labor market and stubborn inflation, which is not really helping us here or helping the Fed here to bring down the interest rate or the inflation. So the target inflation rate for the Fed is also 2%, just like the ECB, and they have quite a long way to go. At the moment, 6.4 is more than 3 times the target inflation rate. Coming back to the European Central Bank, we can see that the prediction done by the economists recently between the 3rd and 9th of Feb, where they point out that even by the end of 2024, the inflation is not going to go down to 2%. So this is not such a good news for us because we can expect another lot of rate hikes. At least what we know here from the rate hikes is that next month in March, they're going to increase the interest rate by another 50 basis points. And also they're going to start the quantitative tightening in the European Central Bank. So therefore, there will be some sort of tightening happening and the liquidity in the market will come down quite dramatically, or maybe not dramatically, maybe a little bit compared to the previous months. So we have to really wait and watch how the liquidity pans out on how the inflation data is coming to come down. But then all the latest trend, what we can see in the market is that all the companies are expecting to have low top line growth. Therefore, they are really pushing hard on their bottom line. So they are becoming lean. They are laying off. They are reducing the capex cycles and so on. So I think going forward, a lot of companies will report low revenue growth, which will then point out to the direction that the inflation is cooling down. So let's wait and watch. Let's not take a premature decision here. But then at the moment, I don't think for the next couple of years, the interest rate is inflation is going to come down anytime. What is another worrying factor that coming in for the ECB is also the wage growth is really picking up in 2023. We have 5%, more than 5% wage growth in 2023, and another 4.5% in 2024, and another 4% in 2025. So this is quite a big jump in the wage for an economy where they are targeting to have a 2% inflation rate. So if we have a wage growth at around 4%, this is not going to really help the European Central Bank or the monetary policy makers to bring down those inflation back to 2%. So we will have a really long time before we reach a 2%, unless there is a really dramatic increase in the interest rate hikes. It's not looking good what data coming in from the market is. We also had couple of really big airports employees going into strike, the Munich and the Frankfurt airport. They are asking for more wages, even though we already have 5% increase in wage growth. They are still asking for more. So I don't really understand here what's happening. But then if it is going to be another increase in the wage again, this is not going to really go well with the ECB, and they might even start increasing the interest rate in much higher pace, maybe another 0.75% or something like that. What I can see here is that there is a big difference in the KPI for the Workers' Council or the Workers' Union, where they are really trying to bring in more money into the pocket of the employees, but they are really forgetting to see that the macro picture. So where the faster the money comes in, the quicker the money goes out of the pocket because of the inflation. So I think from my point of view, I think the workers' union should really focus on bringing down the inflation by pushing the government to the corner, increasing those interest rates really high and so on, so that the money that they have to spend is high. At the moment, they are going in a different direction. Of course, they have different KPIs, and this is what it is. This is how the market works. And we have Ford coming in and presenting that they are going to make 2,300 jobs redundant in Germany directly. So indirectly, maybe another 1,000 jobs will be affected. So let's say 3,000 to 3,500 jobs is lost because of Ford layoff. And I think Ford here is taking the opportunity of the big layoff done by the technological companies, like 10,000, 12,000 layoffs. If you compare that to 2,300, it's not that much. And the reason why they are cutting down this job in Europe is because of the market trend towards the EV. This is something that we have to see. I don't know. I don't think Ford has a really big EV market at the moment. They have Mustang, and I don't think they have a lot of a big portfolio here to make this decision here. I think they are expecting low top line growth, and therefore maybe they are trying to have an improvement in their bottom line. So let's wait and watch how it really progresses for the German economy here. And the final topic for today is really good news coming from the politics, I would say. Mr. Scholz, a couple of weeks back, he was in the South America securing those lithium stocks and also oil from the Argentina and so on. And now we can see that he is expected to travel to Japan next week to get some support from Japan to go into the market collectively and secure a lot of resources, which at the moment is really focused towards China. At the moment, the German industry are really reliant on the Chinese economy, Chinese market, and now Mr. Scholz is really going ahead and diversifying those supply chain policies there. So he went to South America, now he's going to Asia. So he is really coming out of the dependency from Chinese economy, which is completely different to what Mrs. Merkel was doing when she was in the power, where she focused all the supply to Russia and China. Now we have Mr. Scholz going in the completely opposite direction. So I think it's a really good sign to see here before something strange happens, and then again we enter into another big recession or another big mess here. So let's wait and watch how it really progresses from the supply chain resilience what Mr. Scholz is creating. Yeah, that's it for today. Thanks for watching. See you in the next video.